Hello friends. Hope all of you and your families are safe during these times. In the next few minutes, I am going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. Markets in May witnessed significant volatility, almost all of it emanating from global developments. Global markets corrected significantly in the first half of May on fears that global growth is slowing. Inflation prints continue to remain stubbornly high, and so central banks, in a bid to tame down inflation, will further slow down growth. This resulted in large sell-off across equities globally. At one point during the month, Nasdaq was down almost 9%, S&P 500 in US down almost 6%, and Nifty in India was almost down 8% mid-month. Towards the second half of the month, with many high-frequency indicators across the globe, from China to US, suggestive of slowdown, as well as when the US inflation data came a bit soft from previous reading, there was a significant relief rally, recovering most of the losses for the month. The crisis in Ukraine continues to prolong, and while most commodity markets have seen some cool-off, crude oil continues to remain high. Given India's strong import dependency, high crude impacts the economy, and to ease some of this burden, the government reduced some of the excise duties of petrol and diesel. Along with that, government also increased export duties on steel, bringing the Indian steel prices down. These measures will help in containing the runaway inflation that India has seen in the last few months. FIIs continued on their selling spree. They have now sold more than $22 billion calendar year till date, and over the last 7-8 months have been persistent large sellers. Most of this outflow from FIIs have been focused on the IT and financial sectors. Over the last 22 years, FIIs have brought in about $200 billion of flows, which is approximately worth $600 billion because of market appreciation. In contrast, FIIs have significantly lost money in their allocation in some key emerging markets like Russia and of late even in China, where there has been major regulatory impacts. Given such large scale of losses in many major markets and sitting on huge profits on their Indian position, it appears that FIIs want to try and cover some of their losses by booking profits here. Indian households have persisted with their faith in Indian equities by buying into this relentless FIIs selling. Corporate earnings for the quarter ending March 2022 have broadly been along expectations. There has been some pressure on margins due to elevated commodity prices, as well as some impact on sales due to the Omicron wave in Jan and February. Earnings have grown significantly from April 2020 to October 2021, and over the last few quarters have been stabilizing. We expect near-term earnings to be impacted by elevated commodity prices, and in that sense, after a strong rally that Indian equities saw in April 2020 to October 21, it appears that the markets are digesting these gains, with near-term headwinds of FIIs selling, higher commodity costs, and increase in the cost of capital. While these are some near-term headwinds, we do think it better for investors to look through this phase and think about the structural reforms undertaken, as well as the improved fundamental outlook of corporate India. Pre-COVID, the narrative, the newspaper headlines amongst most corporate boardrooms was which asset to sell to save the overall company from being an NPA. Since then, cash flow from operations have approximately doubled over the last 2 years. And today, the discussion in many boardrooms across corporate India have focused now to which new areas to invest in over the next few years. This improving investment outlook, along with the financialization of savings, does provide a strong runway for investment in equities in the medium term. Valuations have moderated a bit as markets have consolidated over the last 7-8 months. For sure, geopolitical risks have gone up, and while direct impact on Indian economy is limited, indirectly, India will get impacted with high energy prices, especially if they sustain at $100 above for long. However, these risks are transient, and unlikely to impact the longer term competitiveness of Indian companies. If any, Indian companies can benefit in the long run with more outsourcing, especially as Ukraine, Eastern Europe was emerging as one of the faster growing suppliers of IT talent, and value chain in the manufacturing sector wanting to move to stable countries like India. Given that ups and downs are part and parcel of asset classes like equities, it is only natural to expect higher volatility in the times ahead. However, rather than obsessing over the fear of fall, we would encourage investors to use such opportunities to increase allocation to equities, especially if one is underweight this asset class, as is the case for majority of Indians. Given this, a disciplined asset allocation with a focus on longer term goals is imperative, and equities continue to fulfill an important avenue for long term goal obligations. Be patient investors, and do remember, time in the market is more important than timing the markets. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.